Hi, it's Doc for the 12minutetrading.com Market Minute for Sunday, the 24th of July. We have a huge week coming up between major tech earnings all week, as well as the Fed meeting on Wednesday. This is peak risk for the third quarter. What happens by Wednesday will set the tone for the rest of this summer. Let's jump into the charts and see what price levels that we're anticipating this week. We're going to start with the S&P 500, and I've got the monthly, weekly, and daily charts up here. These are approximately distant by a factor of 5 from each other. And so this is how we read fractal relationships between the different time frames. The reason that we're using the S&P 500, it's probably the most closely watched and important index that's in the U.S., which really reflects what's going on in the overall stock market, and it's all boiled down into one chart. So it doesn't matter whether we use the SPX or the spiders or the ES futures, whatever we use, it's essentially going to reflect that overall sentiment of the market and the risk that's involved with the market. Now, just overall, what I want to do here is on the monthly chart, I'm going to run some fib retracements from the bottom of the pandemic movement all the way up to the recent top. And so far, what we're seeing is, as we're getting up 2/3 of the way through July, this 38.2% retracement has been holding up as support, at least on a closing basis, which is more important than intra-month. And so to me, this is a good swing down for the first leg of a potential bear. Now, what can happen after this move is we can either see a move back up to form a lower high and then eventually a move back down. And this is going to be the most bearish outcome, is if we do get a rally right now, which leads to a lower high and a third leg of the entire bear market, which is going to be probably the worst one. And if you need evidence of that, we can always go back to the 2008 bear market back here. And we can see that somewhat the same thing happened here. We had our initial move down like this, and then we had a summer rally, and then everything really fell to pieces over the subsequent year into the next year as well, too. So we're really right about this point here if we're going to use the 2008 analog. Now, markets never move in the same manner. The bear markets are never going to attack in the same manner. They never look quite the same, but they do have somewhat of the same structure. And what I'm looking for here is whether or not we're going to get our lower high setting up in today's market. So back to today, this to me does not reflect a lower high setting up. So we're still owed a lower high. And this would be good for both sides of the market if we do bounce up into the month of August, because what that does set up is it makes the bulls happy because they're able to at least maybe clear out some underwater positions and get ready for what could be a rally. And it also helps the bears because it gives them a better platform from which to set up the next short positions. So the question is, do people really want to be opening up brand new short positions down here? And that could be questionable. We've gotten to some real extremes in sentiment recently. Now, the reason that we're looking at this from a technical backdrop is because the market tends to move in a way that satisfies what it needs. So it's almost like the news seems to fit after the fact into what the market wants. So what does the market want at this point? Well, right now, the market is set for a relatively large move on the monthly chart. If we go down to the weekly chart, we've had a lot of downside movement really since the beginning of April and almost into exhaustion. So actually, a market that goes higher from here actually builds up the energy, believe it or not. And so we could see a move up to 4,100 if the news this week brings upon certainty into the market. We're also going down to the daily chart. We're starting to see some energy coming out of the market on the daily chart. So we only have limited upside that we can go maybe just above 4,000, maybe as far as 4,100. before I think this is going to be exhausted. So if we do see certainty coming into the market, it's going to have limited potential to run to the upside, maybe 4,100 or so. So that's if certainty comes into the market. Now, what happens if uncertainty comes into the market? Everybody knows the Fed's probably going to put on a 75 basis point rate hike, but the uncertainty could come in the form of major tech companies blowing it in terms of earnings. So what happens there? If we see the price dropping again, we could see it drop very quickly to form a retest of these lows from back in the latter part of June. And I think if that were to happen, I think this would be about it for the move. I think what we'd see after that would be an even stronger rally to the upside. So I think we're very close for right now on an intermediate basis to being done with the downside. The market's looking for an excuse to rally right now. And if more uncertainty comes into the market this week and we drop down to some form of either retest of the lows or maybe even a higher low from here. So even if it just drops down to 3,700, that would be a higher low. That's going to put the negativity and the sentiment of this market off the charts with respect to pessimism. And I think the market has no place to go after that point, but up into an August rally. So either way, I think we end up a little bit higher from here, not too much higher. I don't think we're going to, just V-bottom from here like we did in 2020. I think it's going to be torturous, any kind of an upside rally from here. And my targets are somewhere around for the end of this summer, maybe 4,200 and maybe just as far as 4,300. We'll have to see, but it all starts by this week. And the big reports start coming on Tuesday, Fed meeting on Wednesday, more big earnings on Wednesday. And then we finish out on Thursday with some more huge earnings after the market close. All right, guys, that is it for today's Market Minute. Thanks for listening, and we'll see you in the next one.